Hi everyone, in this video we're going to start this new chapter of corporate accounting, that is redemption of preference shares. Now first let's understand what is preference share, right? See here, I'm not going to give you any definition and all. I'm just going to take you through the main features of preference shares and you will get what is preference shares. Okay, you will understand what is preference share, right? So the first thing is these preference shares, right, they will have fixed dividend. The preference shareholders, they will get fixed rate of dividend, okay, like 7% preference shares, 8% preference shares, yeah, like that. Okay, and the second thing is these preference shares, they have preferential right. They have preferential right over the equity shareholders. In a company, what happens is, in a company, the dividend of preference shares is paid first, then the equity shares, right? And the capital also. If the company wounds up, then the capital of preference shareholders will be paid first and then the equity shares. So they have priority in the company over the equity shares, right? So this is the main thing about the preference shares. Now, the downside of preference share is that they don't have voting rights. They don't have voting rights. Okay, so that is the thing about the preference shares. Now let's come to the redemption, right? The main core of this chapter. So what do you mean by redemption? See, redemption is nothing but the process of repayment. Redemption means what? Just repayment, that's it. When the company issued preference shares, they got the money. Now it's time for repayment. They are paying back the money. Okay, that is the redemption of preference shares, right? And here you have to understand that when the shares are issued, right, at that time itself, the company will decide at what amount we are going to pay the preference shareholders back. At the maturity date, what are we going to pay you back? That will be decided in the beginning itself, okay, at beforehand itself. So that is pre-arranged amounts. We're going to pay you, for example, the shares were issued at 100 and they are redeemable, they are payable, repayable at 110, okay, 110. That's pre-arranged amounts, okay? And then pre-arranged timing. The maturity date will also be decided in the beforehand itself. When are we gonna pay back? When the company is gonna pay back? That will be decided beforehand. Okay, that is redemption. Now, how do we do it? How do we do it in accounting? How do we do it? How do we do the redemption? Right? That's the main thing here. So for that, we have to understand the Section 55 of the Indian Companies Act 2013, which has a provision which deals with the redemption of preference shares, right? So let's understand Section 55 of the Indian Companies Act 2013. Let's go to Section 55. Now here is the Section 55 of the Indian Companies Act 2013, and we know this section talks about the redemption of preference shares. So let's go through this section and understand what this section talks about the redemption of preference shares, right? Let's start one by one. The first thing is, see here, only fully paid shares can be redeemed. Simple, right? Only fully paid shares can be redeemed. No partly paid up shares can be redeemed. If in case partly paid up shares are given in the question, then you have to assume that final call has been made and all the money has been received, and you have to make a journal entry for that, right? That's simple. That's it. Okay, only fully paid shares can be redeemed. Now the second thing is preference shares can be redeemed by fresh issue of shares or out of profits or combination of both. See, what do we mean by this? See here, now you are making the redemption of preference shares. You are repaying their capital back, right? So you need cash for that. You need money for that, isn't it? So how are you gonna get that money? See, there are only two ways to get that money, okay, or a combination of those two, right? The first way is fresh issue of shares. You are gonna issue new equity shares or new preference shares and you are gonna get money in your company, right? And that money will be used to repay the old preference shares, right? That's the first way. The second way is you can use your profits, the profits which the company has earned in the past and which are in the free reserve. Free reserve means the profits which are available for distribution as dividends, right? Those are free reserves. The company can do anything with that, right? Those are free reserves, not capital reserve, no, not specific reserves, okay? Only free reserve, because free reserves are the only reserve that you can use to distribute it as dividend, right? Only that you can use, okay? Only free reserve can be used to redeem the preference shares, right? Or a combination of those two, okay? Keep that in mind. This is simple, right? Fresh issue of shares or out of profits. Simple. Now you will say in the question it is given that investments are sold to redeem the preference shares. Now you are telling us only there are two ways, right? issue of shares or out of profits. But in the question we have seen that there are given like investments are sold, assets are sold, right? Land is sold, building is sold. See, when you do business and when you earn profit, what happens? When you earn profits, do you keep those profits as it is idle in the company? No, you don't, right? You invest those profits somewhere, right? You buy land, you buy buildings, you buy investments, right? So now when you are in need of money, what you will do? You will sell off those assets, right? Those are profits only you invested and you are earning from those assets. So now what is happening? Now you are in need of money, so you are gonna sell off those assets and get your profits back, get your money back and pay off the preference shares. Okay, so there are only two ways, okay, by fresh issue of shares or out of profits or combination of those two. Okay, don't think that selling of investment is another way. Okay, that's the same thing, out of profits only. Fine. Okay, now let's see the C1. Now premium payable on redemption, C, right? What is premium? The extra payment that is done at the redemption, right? When the shares are issued at the face value, right, at that time itself they will mention that we are gonna pay you back, we are gonna redeem you the preference shares, we are gonna repay you at premium, extra, 10 rupees extra, 20 rupees extra, like that. Okay, that is called premium payable on redemption. Now this section talks about, section 55 in this provision, that how the company is gonna bring the money for this payment, this premium payment. Now here the section 55 has already talked about the nominal value, about the face value. The face value can come out of fresh issue of shares or out of profits, and the profits are only free reserves, not capital reserve, not specific reserve, nothing, only free reserves, right? Now here the section is talking about how the company will bring the money for the premium, the extra payment, right? So here the section says that here there is an amendment. Okay, in the last year there has been an amendment in this provision. Okay, see here the section says that there are two types of companies: the company for whom section 133 applies, the company for whom section 133 applies, right? Now to which company this section applies, 133? See, you don't have to go in detail of that. Okay, it's very simple. Section 133 applies to every company which has an objective of to earn profit. The objective to earn profit, the company which has objective of earning profit, they have to follow the accounting standards. Okay, so section 133 will apply. So the company to whom section 133 applies, they can only use profits, they cannot use securities premium reserve. Securities premium reserve is not a free reserve, right? But before this provision, what was there? Before this amendment, the companies were able to pay the premium on redemption from free reserves, from profits that are available for distribution as dividends, as well as securities premium reserve. But now, since this amendment, the company which follows accounting standard, and every company has to follow accounting standards, right? The company which has objective to earn profit, and most of the companies has objective to earn profit, right? Even the NGOs, most of the NGOs also, right, they also have the objective to earn profit sometimes, right? Not the NGOs, some companies, right, the social companies like that, right? Yeah, and there are some companies to whom section 133 doesn't apply, and those are the companies which doesn't have the objective to earn profit. The company which doesn't have objective to earn profit, so section 133 doesn't apply. Section 133 talks about the accounting standards, right? So they don't have to follow accounting standards. Since they don't have to follow the accounting standards, they can use profits as well as securities premium reserve. Okay, this is the thing. Before the amendment, all the companies were able to use profits as well as securities premium reserve, but now they cannot. Now most of the companies and most of the questions are based on this only, the first scenario, that section 133 is applied. Okay, the companies are profit making, okay, the objective is to make profit, and so they cannot use securities premium, they cannot use. Okay, simple thing, cannot use. But now here there is a trick. See here, what is happening is, in BCom syllabus this is still not updated. Still they are sticking to this before the amendment. How was it? That way. Okay, they are using profits as well as securities premium reserve, and even the universities, the paper are chucked in the universities, right? There also they are considering both profits as well as securities premium, and you are getting marks for that. Okay, so you have to be very careful here. You have to ask your sir, okay, I can't tell you this properly, that whether to go for this or this. Okay, because in BCom the syllabus is not updated. They are still using profits as well as securities premium reserve to make the redemption of premium. Okay, the premium payable on redemption, right? But for the CA guys and the CMA guys, you cannot do that. You have to make use of this provision properly. Okay, you have to follow this properly, because this is the Indian Companies Act 2013. I'm not saying this, right? Okay, then be very careful. Okay, but the BCom students, you have to ask your sir, and mostly you have to use both of them. Okay, but this is a provision. Okay, you have to ask to your sir. Fine. Now let's see the another provision of this section 55, that is, okay, after redemption of preference share. This is very important here. Now let's see this. Now here is the last provision of section 55 that we are going to discuss now, and see, this is one of the important provision of section 55. Okay, you have to get this logically, right? So let's understand this provision. See here, D, after redemption of preference shares, total capital should be same. Total capital as in the sense preference share capital plus equity share capital. Okay, both equity plus preference should be same. It should be intact. But how is it possible? How total capital is going to be same if we are repaying the preference shareholders, right? In the balance sheet, now you have preference share capital, but once you pay off the preference share capital, right? Once you pay off the preference shareholders, then in the balance sheet preference shares would not be there, right? Isn't it? They would not be there. See here, for example, this company ABC Limited, right? Let's say it has equity share of 100 rupees, just for an example. Preference shares of 50, total capital is 150. But after the redemption, what will happen? What will happen? Equity share will be the same, 100, but the preference share capital would not be there, right? It would no longer be there. So the total capital of the company will be reduced. From 150, it became 100. The total capital, equity plus preference, isn't it? Now what does the section 55 tells us? Section 55 says that, this section says that the total capital of the company should not be reduced. It should be intact. It should be same. But why? Why it should be same? Why? What's the logic? Yeah, now let's understand that logic, right? See here, if total capital is not same, why is it a problem, right? Yes, see, let's see that. See here, let's say there are two companies, company A and company B. Now, as you can see here, company A is financed by equity of 80%, 80% of equity and 20% of debt. Okay, and then company B is financed by 40% of equity and 60% of debt, right? Now think from the point of view of an potential investor, debenture holder, potential, and then think from the point of view of creditors, bankers. Yeah, now if you want to do business with any of these two companies, which one would you prefer? Which one? Of course you will prefer this company, because in this company there is less financial risk compared to the company B, which has more financial risk. How this company has more financial risk? See, the thing is, this company is so much in debt. This company is financed by debt, isn't it? It is very risky, isn't it? It has so much debt here. 60% of the company's capital is financed by debt, right? So this is the problem here in this company. Now, the investors, the debenture holders and all, they would not prefer to invest in this company, right? Because this company is already in so much debt. So if we invest in this company, then the chances of losing the money is far greater than here, right? Here it is very safe, isn't it? Here there is less financial risk. Here there is more owner's capital, owned funds, equity, but here there is less equity. This is highly geared company, highly leveraged company, but here this is not, right? This is good company, right? This is the problem here. This is the problem arises with debt. If so much debt is there, then there will be more risk, right? So what will happen? See here, let's say here there was 100 debt. Okay, so what will happen is, as the capital will get reduced after the redemption, as the capital will get reduced, the equity plus preference, the debt would remain the same, right? The debt would remain 100 only, but the capital is decreasing. That means the percentage of owner funds, right, the equity plus preference will get reduced compared to the debt. So the company will become risky. The company will become risky. And there is a thing in the company, the sequence of payment. First the liabilities are paid off, isn't it? First the bank loan, debenture holders, all their capitals and all are paid off, and then the turn of preference share capital comes, and then the turn of equity share capital comes. This is the simple sequence of payment in a company, right? So here what is happening, we are making the payment directly to the preference share capital. We are not here in redemption of preference shares. What is happening, we are directly paying off the preference share capital. We are not concerned about the liabilities only. So that's the problem, we are directly going to preference share capital. So that is why section 55 came into account, to safeguard the interest of the liabilities holders, like the debenture holders, creditors, bankers, right? What will happen if we make the payment to preference share capital, if we redeem their capital, which we have to, right? The maturity period is there, so we have to redeem the preference share capital. So what happens? The problem arises. The problem is that these people will get very tensed, you know. These people will think our money is not safe over here because these guys are getting the payment first. So to safeguard their interest, what the section 55 tells us? The section 55 tells us that total capital should be same, so that these guys don't have to worry, the liabilities guys, the bankers and all, right, in the company, if there is a bank loan and all, they don't have to worry about their money, right? So that is why what section 55 tells us is that total capital should be same, it should be intact, you know. And as I said that that if there is more financial risk, then what will happen? The outsider wouldn't lend anymore, right? They wouldn't invest in this company like that. So the reputation of the company will go down in the market if there is more debt. And if we don't comply with the section 55, what will happen? As I said, the total capital will reduce, but in proportion to the debt, the owner funds will get reduced, and then it will become very risky. So that is why what section 55 suggests is that total capital should be same. But how is it possible that total capital can be kept same? It is possible. It is possible by replacing the old capital. By what? By replacing the old capital, right? So how do we replace the old capital? We have to understand that. See, we can replace the old capital by making fresh issue of equity shares. For example, see here, I will show you, right? See here, what we can do is to replace the old preference share capital, which is no longer gonna be there, right? The preference share capital which is going to be redeemed, it is no longer going to be there, right? So now we have to replace that preference share capitals. So how to do it? Don't worry, there are two ways to do that. Two ways. The first way is we can replace that preference share capital through fresh issue of equity shares. What? Fresh issue of equity shares equivalent to the preference shares redeemed. How much preference share capital are we redeeming? That much we have to issue fresh equity shares, new equity shares, so that the total capital can remain same, replacement of capital, right? And the another way is to transfer the profit as in the sense free reserves, profit and loss credit balance, general reserve, dividend equalization reserve, right? We can use this, and this profit can be transferred to CRR. What is CRR? CRR is capital redemption reserve. This is not a free reserve. What is happening over here is we are giving the guarantee, we as in company are giving the guarantee to our third party, that is the liabilities that you guys don't have to worry. Yes, we are making the payment of preference share capital and we have to, but don't worry, as mentioned in the section 55 of the Indian Companies Act, that total capital should remain the same, and if total capital remains the same, there would not be any more risk, right? So to comply with that, what are we going to do is we are going to replace this capital, the capital that is going out of the company. So to replace that capital, we have two ways, as I said, fresh issue or to transfer the profit to CRR. So this money is now free reserve, profit, general reserve, P&L, dividend equalization reserve. This money, this profit, we can use for anything in the company, anything. Okay, whatever the company wants, they can do with that. But here we are replacing the capital, right? We need to replace the capital, the old preference share capital. So we are transferring this profit to this special reserve, this capital reserve, which can be used only according to the Indian Companies Act 2013. We cannot use this CRR reserve as we like, as the company like. No, just according to the Indian Companies Act 2013 as mentioned there. And in Indian Companies Act 2013, it is mentioned that CRR can only be used to issue bonus shares. You're getting now? It can be only used to issue bonus shares. So what is happening over here is that this CRR can be only used to issue bonus shares, right? It can be only used to issue bonus shares. That means ultimately this CRR will get converted to what? It will get converted to share capital. Okay, it will get converted to share capital. That is the idea here, replacing the old capital so that the interest of these guys are safe. That is why section 55 came into existence, right? So how is it happening, right? Let's see that. See here, ABC Limited, equity share is 100, just for an example. Preference share is 150, okay, just for an example. So now we are redeeming the preference shares, right? The total capital is 150 before the redemption. Now after the redemption, what will happen? Preference share capital is no longer gonna be there. But as I said, we have to replace the capital so that the total capital should be same, right? Equity plus preference, total capital should be same. So to comply with the section 55, we are gonna issue fresh equity shares. So 100 old equity shares, right, as it was, and then new equity share, the fresh equity shares we are gonna issue, that is 50, equivalent to the preference share that was there before, so that the total capital can remain the same and the company doesn't get risky. That is the idea over here in fresh issue of equity shares. You get this? Simple. Here, as I said, we are converting the profits into CRR, right? Capital redemption reserve, which ultimately gets converted into share capital, and the same thing happens, right? The total capital remains the same, because the capital redemption reserve can only be used to issue bonus shares, free shares, okay, bonus shares. It is issued to the existing shareholders, right, the bonus shares, right? Now, so ABC Limited. Now here, if you can see, equity share is 100, preference share is 50, and the general reserve, let's say it's a general reserve, right, free reserve 80, right? So now what is happening? We are redeeming the preference shares 50, okay? So it is no longer gonna be there. So after redemption, equity share will be 100, CRR will be 50. We will transfer from reserves, from 80, this reserve, we're going to transfer this to CRR, right? Once we do that, what will happen? The total capital will be the same. See here, before it was 150, total capital 150 before, right? Equity 100, preference 50. Now also it's the same. Equity share 100 and CRR, which will ultimately get converted into bonus shares. That is guaranteed, okay? That is guaranteed. So that is the thing. So it will ultimately get converted. So we can say that this is total capital. This can be included in the total capital. So 100 plus 50, 150. So the total capital like this will remain the same. Okay. The first way is fresh issue of equity shares. The second way is to convert the profit, to transfer the profit, free reserves to CRR. Okay. This is what has to be done and has to be complied. Okay, we have to comply with the section 55 of the Indian Companies Act 2013. Simple, right? This is the thing. It's very simple. Okay, once we solve the problem, you will get this. It's very simple. Okay, all right then. So now in the next video, what are we going to do is we are going to cover the journal entries and the technique of solving the problems, right? And then in the third video, we are going to solve the problem, right? Okay then, see you in the next video, right?